Did you know that 90% of people who buy stocks aren't actually investing? Instead, they're just gambling with their money. Shocking, right? Most people think they're building wealth by buying shares, but they're just following the latest trends or chasing quick profits. Here's a hard truth. If you're not thinking like an investor, you're probably setting yourself up to lose money. But here's the good news, it's not too late to change. What if I told you that with just a small shift in mindset, you could start making smarter financial decisions? You don't need to be a billionaire like Warren Buffett to think like one. The key is understanding what real investing is all about. In this video, we're going to explore why you're not truly an investor yet, and more importantly, how to think like one. You'll learn how to spot real opportunities, tune out the noise, and find value where others overlook it. Get ready for a new way of thinking that could change your financial future forever. So, if you're tired of following the crowd and ready to make smarter investment decisions, keep watching. The truth about investing is about to get a lot clearer. Chapter 1. The Illusion of Investing. Why you're not one yet. When most people think about investing, they picture buying stocks and watching them grow. But here's the truth, many of us aren't really investors. We're just playing a guessing game. The difference? Investors think long-term, while speculators chase quick gains. Let's break that down. The stock market isn't a casino, yet many people treat it like one. They buy based on trends, rumors, or the latest hot tip from social media. This is speculation, not investing. Value investing, a strategy made famous by Warren Buffett, means buying a stake in something you believe in for the long haul. Buffett once said, "Our favorite holding period is forever." That's because real investors are interested in owning a piece of a great business, not just trading stocks. Speculating can lead to big losses, and the stats back that up. In fact, studies show that over 80% of day traders lose money in the long run. Why? They're often caught up in short-term market fluctuations instead of looking at the big picture. It's easy to get distracted by stock price swings, but real investors look deeper. They study the fundamentals of a company, its earnings, its leadership, and its growth potential. The first step in becoming a real investor is thinking like one. Understand that investing isn't about chasing hot tips or trying to time the market. It's about buying businesses, not just stocks. And if you're not prepared to sit on your investments for years, you're not really an investor yet. Chapter 2. The Power of Thinking Like an Investor. Unlocking your financial future. The secret to building wealth through investing isn't always about what you invest in, it's about how you think. You don't need to be a billionaire to think like an investor. What you need is a long-term mindset, the willingness to make educated decisions, and patience. The stock market rewards those who are patient. It's not about timing the market, it's about time in the market. According to a study by Morningstar, investors who held their stocks for 10+ years earned an average of 9.1% per year, versus just 4.2% for those who traded frequently. Patience pays off, it's simple, but it's often ignored. One powerful way to think like an investor is to follow the advice of Charlie Munger, Buffett's longtime partner. The big money is not in the buying or the selling, but in the waiting. That's where value investing comes in. It's about finding stocks that are undervalued today, waiting for the market to realize their true worth, and holding on until that moment comes. However, long-term thinking is hard. In today's world, where everyone wants instant gratification, it's easy to get distracted. But research shows that those who think long-term tend to make better decisions. For example, when you focus on quality companies, you'll avoid the temptation to chase fads or react to market noise. You're in it for the long haul, and that gives you an advantage. In practical terms, thinking like an investor means focusing on value, not price. A stock might be priced low today, but is it undervalued? You need to think about what the company is worth based on fundamentals like revenue, earnings growth, and competitive advantage. If you think like an investor, you're always looking at the bigger picture. Chapter 3. Value over hype. How to tune out the noise. In the age of social media, it's easy to get swept up in the hype. One day a stock is trending because a celebrity mentioned it, and the next day, everyone's talking about the next big thing. But here's the thing. That's not how real investors make money. They focus on value, not noise. Here's a fact. The most successful investors aren't the ones who chase after hot stocks. They're the ones who stick to their strategy and ignore the distractions. Studies show that investors who focus on value investing, like Buffett, outperform the market over the long term. The S&P 500 has averaged around 10% annually, but Buffett's Berkshire Hathaway has outpaced that with an average return of 20% over the last 50 years. To tune out the noise, you need a filter. That's where the concept of intrinsic value comes in. Intrinsic value is what a company is really worth based on its fundamentals. If you can figure that out, you won't get swayed by headlines or rumors. You'll make decisions based on solid data, not emotions. This doesn't mean you should ignore market trends entirely. But when it comes to investing, trends should be secondary to fundamentals. If you're constantly reacting to the latest trend, you're speculating, not investing. And while speculation might feel exciting, it's far riskier. According to the CFA Institute, the average investor underperforms the market by 2–3% per year because they're chasing trends instead of sticking to a strategy. Buffett often says, the stock market is a device for transferring money from the impatient to the patient. This is where most people lose money. They get impatient, follow the hype, and end up buying high and selling low. Value investors do the opposite. They buy when others are fearful and sell when others are greedy. To make this work, you need a strategy. A good strategy involves picking companies that are undervalued by the market but have strong fundamentals. That way, you're not betting on trends or hoping for luck. You're making a well-reasoned investment. If you found this helpful, don't forget to subscribe to our channel for more valuable investing insights. Hit the bell icon so you never miss a tip to improve your financial future. Chapter 4. The Hidden Riches in Boring Stocks. Where the real returns are in the world of investing, the exciting stocks often steal the spotlight. We see headlines about flashy tech startups and hyped-up IPOs, but the true wealth is often found in the boring stocks, the ones that don't make the news. It's easy to get distracted by the latest trends, but there's more money to be made in quiet, stable companies that offer consistent growth. Take Coca-Cola, for example. The company has been around for over 130 years, yet it's still one of the most successful investments over the long haul. Warren Buffett invested in Coca-Cola back in 1988, and it's grown into one of his most profitable holdings. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Coca-Cola wasn't sexy or new when Buffett bought it, but it was a proven business that generated steady profits year after year. This is the key: consistency matters. Investors who chase the latest buzz often get caught up in short-term price swings. But real wealth is built when you invest in companies with strong, predictable earnings and a solid competitive advantage. A study from J.P. Morgan Asset Management found that the top 10% of stocks by total return generated a huge portion of market gains over the last 90 years. Many of those stocks were, you guessed it, boring companies, like Pepsi, Johnson & Johnson, and Procter & Gamble. In fact, many of the most successful value investors, like Buffett and Charlie Munger, focus on companies that seem unexciting at first glance. But these companies have one thing in common: they're great at what they do, and they generate predictable cash flow. This is how they build long-term wealth. The lesson here is clear: boring can be beautiful when it comes to investing. The companies that provide steady, predictable returns are often the ones that offer the best opportunities for long-term growth. Don't let the hype fool you into thinking you need to chase the latest trends. Stick to the basics. Find solid companies, buy at a fair price, and hold for the long term. Chapter 5. You're not just buying stocks, you're buying a business. Many investors treat stocks like lottery tickets. They buy them, wait for a big payoff, and hope for the best. But when you think like an investor, you're not just buying stocks, you're buying a piece of a business. This shift in mindset can make all the difference in how you evaluate investments. When Warren Buffett buys stock, he doesn't just look at the price. He asks himself, would I want to own 100% of this business? If the answer is yes, then it's a good investment. This approach forces you to think beyond short-term market movements and focus on the underlying business itself. Does the company have a strong management team? Does it have a competitive edge? Is it likely to grow over time? These are the kinds of questions you need to ask. You can learn a lot from the way Buffett and other value investors evaluate businesses. They look at the company's fundamentals, not just the stock price. They focus on metrics like earnings, debt, and the quality of the company's products or services. For example, Buffett has often praised companies with a moat, a competitive advantage that protects them from competitors. Coca-Cola has a massive moat with its brand, which is why Buffett has held onto his shares for decades. One thing to remember is that investing in a business means understanding its risks. Not every business will succeed, and some will fail. But when you're investing in a company you understand and believe in, the risks become manageable. For instance, if you know a company has a strong balance sheet and a history of innovation, you're less likely to panic when stock prices dip in the short term. In the long run, the market will reward those who buy solid businesses at fair prices. You don't need to be a stock trader or a market expert to succeed. Just think like an owner. And if you wouldn't want to own the business outright, it's probably not a stock worth buying. Chapter 6. The next big thing is right in front of you. Finding value in unlikely places. When most people think about finding a great investment, they focus on the next big thing, something exciting, new, and disruptive. But often, the best opportunities aren't in the flashy sectors. They're in industries that others overlook or write off. The next big thing might be hiding in plain sight. Take the example of Walmart. When the company went public in 1970, it wasn't the flashy tech startup everyone was talking about. In fact, many investors were skeptical. But the company had something more important, a unique business model that focused on offering low prices and vast distribution networks. Walmart's ability to scale quickly and operate efficiently made it a long-term winner for investors who saw the potential. The same is true today. There are plenty of businesses quietly growing behind the scenes. These are the companies that are consistently improving their operations, growing their market share, and providing value to their customers. Yet because they're not in the hot industries, many investors overlook them. Research shows that stocks in slower-growing sectors, like utilities or consumer staples, often outperform high-growth sectors in the long term. According to a study by Vanguard, from 1988 to 2018, stocks in the utilities sector outperformed stocks in the technology sector by more than 1.5% annually. It's not because utilities are sexy, but because they provide steady, reliable returns. In the same vein, look for companies that are in the boring industries but are positioned to capitalize on long-term trends. Think about companies that are innovating in traditional sectors like manufacturing, agriculture, or even oil. These industries may not get the same attention as tech startups, but they are vital parts of the global economy. The key takeaway is to focus on finding value in places others aren't looking. Stop chasing the hype and start thinking about the companies that will still be around decades from now, providing essential products and services. The next big thing might be right in front of you, in an unlikely industry or company. Don't forget to subscribe. We'll keep sharing tips and strategies to help you become a smarter, more successful investor.